Hey there, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com from a beautifully sunny Redmond, Washington. Hope you are all doing well, and thanks for joining us today on the show and every weekday after the close as we break down the market action using the power of the Stockcharts platform. This is a platform designed to empower you to understand the markets, to make better decisions, to manage behavioral biases, and to really understand the context of what is happening by focusing on visual analysis of price trend and momentum and volume, all those tools of the technical toolkit. The market's in a vulnerable position. We're continuing to see distribution through the course of the trading today. As we bring up some of my charts here in a few moments, you'll see some of my downside alerts have indeed been triggered. We have a great guest today, by the way, Danielle Shay of Simpler Trading. Always some thoughtful ideas, really talking about some of those leading growth names and some of the charts starting to rotate lower. What sort of things, what sort of levels and signals would help us to differentiate a short-term pullback from something a little more significant? With that all in mind, let's get to our market recap and focus on how the markets traded today. Before we bring up the charts, I do want to point out a poll we had going. Which sector do you think performs better over the next 3 months? You have two choices, offense or defense. Consumer discretionary, the XLY, only got 30% of the responses, which is stunning to me. Consumer staples, the far more defensive play, gets 70% of the votes. This is actually a great surprise. I love surprises. I'm not surprised because the market is looking vulnerable. I'm a little surprised because consumer staples have looked absolutely painful. We're looking now at the ratio of consumer discretionary versus consumer staples. Here we are on a cap-weighted basis on the top. The problem with the cap-weighted version of those two is that the XLY is dominated by 2 or 3 names: Amazon, Tesla, Home Depot. Tesla in particular showing a lot of weakness, and that's been dragging the XLY down. But looky here, the consumer staples sector actually outperforming on an equal weighted basis, and that ratio really starting to break down. So I'm going to assume all of you that said consumer staples, you are thoughtful users of my Mindful Investor Live chart list. You're checking this out and seeing that breakdown, thinking a little more defensively here in Q2. Earnings season, we're kind of in the midst of it. And maybe that provides some of the downside catalysts that would keep that ratio going lower. I did want to point out, by the way, before we get to the dashboard, here are some of the alerts that were triggered as a reminder. What a platform like Stockcharts, I think, is most helpful to you as an investor if you use things like alerts and scans, which help you monitor market conditions, really let the platform monitor them for you. Talking about making life a little easier. My line in the sand for the S&P has been 50-50. That triggered this morning at 10:51 a.m. Eastern. Bitcoin below 60K was my risk-off sign for Bitcoin. That triggered just before lunchtime Eastern time. We'll get back to the chart of the S&P in a moment, but do want to point out some of those alerts that we've been talking about, certainly coming to fruition this week. Here we're looking at our market dashboard. You can see that the S&P 500 down about 0.6%, so it really wasn't an end-of-the-world kind of day, but it certainly felt like it with a lot of charts breaking down through key levels. And it's funny, when we're at all-time highs and we're down 0.5%, it doesn't feel like much. But when we go 0.5% and it goes through a key support level, 0.5% means a lot more. And I would say that's kind of the situation we're seeing now with the S&P 500. We finished today at 50.22. The NASDAQ composite down a little bit more, almost doubling the downside move, down about 1.2%. Mid caps, small caps, all down as well. The VIX actually moved slightly lower today, not too much. But you can see here at the bottom of the front page, the VIX did spike above 19 just around lunchtime Eastern, but did finish today back a little bit lower, so slightly lower, still above 18, and in that 15 to 20 range for me for volatility. Basically says volatility is in line with previous pullbacks. VIX above 20 is where it starts to feel like the volatility conditions similar to previous more significant drawdowns, what we might call a corrective move, something a little more deeper and more painful. Looking at the interest rate environment overall lightening up a bit. The 10-year yield finished the day lower to 4.59. The 5-year point a little higher at 4.62. And the long bond yield just slightly below 4.7%. So bond yields came down. Bond prices went a little bit higher. So you can see the TLT is up about 1.1%. The dollar about 1/3% lower from yesterday's close. Looking at the commodity space, the broader commodity space actually down quite a bit. The DBC, which is a commodity ETF, covers a lot of different parts of the commodity complex, was down over 1.5%. Crude oil price is really the biggest down weight there, down about 3% for the USO. Gold prices down with the GLD down about 0.75%. Silver actually and copper slightly higher from yesterday's close. Looking at cryptocurrencies, boy, it's not great. Bitcoin tried to mount a rally sort of the overnight hours Eastern time, but currently trading around 61,300, we'll call it. That's down about 4%. If you look at the sort of 2-day preview chart, which as I've used stock charts more and more over time, has become more and more of the way that I just think about today's action versus yesterday. It's such a great quick reference about what you're seeing right now versus what just happened yesterday. And if you look at this every day, you really start to get a consistent view of how market conditions are changing. Look at how we briefly touched 60,000. I've mentioned this so many times that big round numbers actually have meaning, and I'm not making that up. There's actually been academic research, some of the first research published on technical analysis, if you think about in general analysis of stock and commodity prices, was about how orders would cluster at big round numbers. It actually has been shown to be true. So the fact that something like Bitcoin finds support right at 60,000 is no surprise. That's because enough of us think of that as a meaningful level. It indeed becomes a meaningful level because that's where we put orders and that's where we get filled. And that's what is happening for now. So Bitcoin's certainly in a period of short-term weakness. Yesterday on the show, by the way, we talked about the Bitcoin halving, which is due this week. That's where the amount of Bitcoin you get from a successful mining block gets cut in half, and that's a sign structurally that Bitcoin has matured a little bit further. Usually short-term choppiness, long-term bullishness with previous Bitcoin halvings. Looking at the 11 S&P sectors, you can see the utilities sector up just over 2%. So utilities, the number one sector, followed by consumer staples, financials, and materials. And those last three not up by much, about 1/4 to 1/3%. The rest of the S&P 11 sectors were down today. Technology, the biggest drag on the S&P and certainly the NASDAQ, down 1.4%. Real estate, number 2 from the bottom, and industrials, number 3. That drag on technology is a painful one. When the XLK is the worst performing sector, usually means the major averages are going to struggle a little bit. And certainly the Qs are going to be struggling. Today's guest, by the way, Danielle, Shay, will talk a little bit more about technology, some of the biggest weights in the consumer space, and what that might mean. As we continue to go around the stock charts dashboard here, the market model, what I call the market trend model, currently bearish on the short term on all the equity averages that we track, large cap, mid cap, small cap, and the NASDAQ 100. Now, of course, the medium term and long term models are so positive for me. And what that tells me is at this point, this is a pullback, but the primary trend, that bigger picture trend, is still positive. And I think if you look at most charts, that's kind of what they look like, right? Amazon and Netflix are still in a general uptrend. If you take a step back from your monitor, it's just in the short term that we're feeling a lot more pain. Looking at the what we'll call the Magnificent Seven and Friends, and again, actively looking for a better name than the Magnificent Seven. Now, I've heard people call it the Magnificent Four. I don't like that one. I've had people say the Fab Four. I think that's a little too tied to basketball. So open question. If you have ideas, drop a comment below the video here and let me know what we should call this group of leadership names. Think of those 4 names: Microsoft, Netflix, Amazon, Meta. These are the 4 charts that remain quite strong. Maybe NVIDIA's in that bucket as well. NVIDIA, by the way, down the most today, down almost 4%. That hurts. And I tell you, we have earnings coming up this week from Taiwan Semiconductor. The SMH is testing its 50-day moving average, and charts like NVIDIA are struggling to hold support as well. And as we've mentioned many times, in a bullish market environment, leading stocks like NVIDIA pull back to a 50-day moving average and usually find support. They pull back to previous swing lows and they hold them. And you can see just on the chart of NVIDIA how that's happened a number of times, right? In December and January, recently you saw how it pulled back to an ascending 50-day moving average before resolving higher. You can see in August, in October of last year, we found support at a previous swing low from June. So, stocks that are constructive when the overall market conditions are healthy enough will find support where you'd expect. The danger scenario is where stocks don't find support where you think they should. So NVIDIA, I almost called it Netflix, NVIDIA testing support around 850, testing the 50-day moving average. I think we're right at that point. The RSI for now is just slightly above 40. Those are all pretty common within pullbacks, which are totally normal, even in a very bullish primary trend. But those things start to break, and I think that's where you have to question the sustainability of this uptrend. Again, NVIDIA is one of the few names still holding up just fine above its 50-day moving average. Let's look at the chart of the S&P here, the daily chart, just to see how things have played out. As I mentioned many times here recently, 50-50 is my line in the sand. That's that pink horizontal line we've had on our chart here really since February. February is when we made a new all-time high here at 50-50. We chopped around for about a week and a half before gapping above there. And then that resistance level became support. That's what we call a pivot point, which is a level where we tend to find support and resistance around the same level. This also is called the concept of polarity, which is where a level can serve as both support and resistance. That's a well-documented phenomenon if you analyze price through the technical analysis toolkit. What is also well documented is when you break down through support, it's usually not a good thing. When the momentum breaks to more bearish ranges, that's probably not a good thing either. So I would say, given that deterioration, I'm already starting to think of some downside targets. I have a chart with Fibonacci relationships I'll share a little later in the show, talk about some of the downside targets that make sense for me. But overall, I would say the break today is meaningful. Now, we're in the midst of earnings season. We're really getting into the meat of it here. We've got Netflix, I think, is tomorrow. Yeah, tomorrow after the close. And in the coming weeks, we have a lot of the previous mega cap growth names all reporting as well. And so a lot of eyeballs would be focused on those earnings numbers, any economic data that would come out as well. But for now, the S&P is breaking through support. We'll see if we can close back above 50-50. When you break support, it's all about follow through, whether we see additional moves in that direction. For now, we'll look to see what happens on tomorrow's session, I would say, more than anything. The breadth conditions certainly are not strong. The McClellan oscillator is well below the zero level. We've highlighted that here recently. On Monday's show, by the way, we did a segment called Banking on Breadth, where we dug a little bit into some of the breadth conditions. One of the indicators we highlighted was the percent of stocks above their 50-day moving average, which indeed broke below 50%. It's now down to 30%, which means less than a third of the S&P members remain above their 50-day moving average. That is not bullish. That's actually kind of negative. And if you look, the last time we were above the 50% level and then broke below was in mid-August, and that was right after the peak in late July. A couple weeks later, we broke through that indicator. The S&P just broke through its 50-day moving average. As you know, we had a couple more months of a downtrend, and that's kind of what we're seeing right about now. There's no guarantee that this one looks just like the other one, but it's worth noting that in recent market history, this has looked very similar to previous drawdowns that have been a little more sustained rather than just an initial sort of 3 to 4 week pullback. Do want to look at the chart of Bitcoin here for a moment, and then we'll look at some individual stocks. A lot of earnings going on here right now, so more and more we'll focus a bit on earnings. But I do want to highlight the chart of Bitcoin because we're testing key support here right around that 60,000 level. Big round numbers are super important on the chart of Bitcoin. I've highlighted those with these blue horizontal lines, and I just have them on the chart at all times. If you look back, you'll find so many examples of where Bitcoin will find support or resistance at one of those big round numbers, big sort of 10K increments. You can see most recently, we are trading down to the 60,000 level. You can see that's also, excuse me, that's also a 38.2% retracement down to the January low. So if you take the January low to the March high, 38.2% of the way down would be here around 60,300. It's right around that big round number support. It's also pretty close to that swing low from mid-March. So it certainly seems like Bitcoin is testing a support level. We'll see if it's able to hold this. And again, what's overall on the top of my mind as I'm looking at that chart is we have the Bitcoin halving, which traditionally has actually been quite constructive. The 6 to 12 months after that Bitcoin halving occurs is usually quite bullish. So does Bitcoin hold support where the RSI is right around 40? That would be my question for Bitcoin. If not, this chart all of a sudden starts to look a lot more vulnerable. 52,000 would be the next support level down, according to my analysis using the previous swing lows and highs, and also the next Fibonacci support level. So keep an eye on 60K through the course of this week. Just to finish off looking at some individual stocks, I will tell you Amazon is one of those names that's top of mind for me because it's still going up. And even though the last week has actually been a little more negative, as prices have come down in the last week after testing resistance at 190 overall, we're remaining above an ascending 50-day moving average. That's actually a bullish sign as long as we hold that 50-day. If we're unable to hold the 50-day, as we've talked about with breadth conditions and with other things as well, that could be a cause for concern. The RSI is still remaining above 50 and the relative strength is strong. So Amazon is one of those charts that's holding up pretty well for now. By the way, this is one of the 10 stocks we'll be highlighting on Friday when we tell you about our top 10 charts for April 2024. Grayson Rose and I will share with you 5 stocks each. Amazon is one of mine. Make sure you tune in to hear the other 9 and all of the technical descriptions about all of those different plays. Let's talk about airlines briefly. You can see United Airlines. This is an earnings name up almost 20% today, reported yesterday, I think after the close, gapping higher back above the 200-day moving average, pushing to the upside. And what's interesting is even through yesterday, United Airlines, some of the other airlines looked pretty vulnerable as we were testing support, really struggling to hold support, and very questionable as to whether we would be able to regain the previous highs. Today, gapping higher and up 17.5%. So I like that. I think on a day like today, it's all about the next day. After an earnings gap, it's all about whether additional buyers would come in and continue to push prices a little bit further. You know, what concerns me given the overall conditions in stocks is that a chart like United Airlines, even if it's a good chart, if people are just taking bets off the table, if people are going more risk off because of the broader market weakness, there just won't be a lot of natural buyers looking to buy a name like UAL that's popping higher. So I think tomorrow, going through Friday's session could be key to see if you see additional buyers coming in, pushing stock to further 3-month highs. JB Hunt is one that actually gapped lower on earnings. This is another one that reported after the close today. JB Hunt, a big trucking company, if you're not familiar. So gapping lower. What's interesting about the chart of JBHT with the gap lower is that we're gapping down into price support. Now, this is not the type of chart that I would normally be all about. This is not my classic kind of name. I'd much rather own things that are going up than things that are going down. But when I see something that's oversold, as it is testing a well-established support level, in this case around 163 to 165, maybe it's an opportunity to buy at previous support. We'll see again tomorrow if buyers come in and are able to push that price a little bit higher. Just to finish off, couple names reporting after the close today. We don't have time to go through what the reports actually are because that's sort of actively coming out as we're recording the show here. But I'd highlight industrial and the industrial sector. Railroads, CSX is actually reporting after the close today. It was down about 2%, so not looking particularly strong going into today's earnings report. It is just above the 200-day moving average. Some of these trucking names and railroad names and others have been a little bit vulnerable. We'll see if they're able to hold support. Also, Alcoa, which has been one of the more improving charts here recently. Look at the relative strength at the bottom, actually starting to turn higher. Holding support for now around 35. As we report after the close today, I think it's all about whether that 35 level is able to hold or not. That's it for our market recap. We have a great guest today, Danielle Shay of Simpler Trading, coming on here in a few moments. Before we get to Danielle's comments, let's have a couple quick announcements. First off, we welcome your questions. We'll do a mailbag segment soon, and we'd love to answer one of your questions on our show. You can email us your questions at thefinalbar@stockcharts.com. We're on X at FinalBarSCTV, and here on YouTube, of course. Just drop your question below the video that you're watching. We appreciate so much all of your thoughtful questions. I hope to answer one of yours in our next mailbag show. Also, to let you know, we talked a lot about breadth conditions here recently. I think breadth is really deteriorating. I'm going to do a webcast on Tuesday, the 23rd at 1 p.m. Eastern called Breaking Down Breadth. I actually did this webinar 2 years ago in February of 2022. And if you know your market history, that was right before a pretty significant drawdown in stocks. I'm seeing a lot of similarities. So we'll look at some of the common breadth indicators that I like to use. I'll talk to you about how they're calculated and show how they relate to previous market peaks, why it's an important part of my market top checklist. So to sign up for that free webcast coming up next Tuesday, go to marketmisbehavior.com/breadth. I want to welcome on today's guest, Danielle Shay. Danielle's the VP of Options at Simpler Trading, now coming to us locally from the Seattle area. How is the life in the Pacific Northwest treating you, Danielle? Okay.
Oh, it's gorgeous and it's nice to be close now.
Right? We'll get you in the studio as often as we can, but good to have you nearby. And we're right at that sweet spot, as you know, where the weather in the Seattle area gets really, really nice. So hopefully we both get a chance to enjoy it. Looking at the markets here, we talked in our market recap about, obviously a lot of signs of distribution, breadth conditions getting more and more concerning. We're looking at your chart of the QQQ. What strikes you as you take a step back and observe what's happened through the course of this week here and in recent weeks?
So when you look at the cues, there are a couple different important things to point out. I mean, number one, you have a daily squeeze. So we have this squeeze because we have this consolidation. Here's the thing about the squeeze is it normally breaks out in the direction of the trend, but in this case, this one is breaking to the downside. This is going to happen every now and again, and there's a couple different signals that you have to look at. First of all, you have to look at the moving averages. When you see a pullback, you want to see how far the chart's pulling back. And in this case, it's actually broken through the 50 simple on the daily chart. That hasn't occurred since last August. So when it occurred last August, we ended up seeing about 3 months of a pullback in the market. And so there's definitely a couple signs right here that we could see a deeper pullback, but I'll tell you one positive thing happened today, which is the fact that the put call ratio traded up above 1. And whenever that happens, it means everyone is so bearish. We could get a bounce if we get a positive catalyst.
Yeah, it's sort of that contrarian bullish signal, right? When the put call ratio hits that point, often has been aligned with short-term lows. We'll see. We're looking at some of the leading names within the QQQ. Not particularly strong though. Tesla's a name you were trading around recently. What do you see here on the chart of Tesla?
So whenever you start to see the NASDAQ not just pulling back, but really shifting in trend and breaking lower, the main thing that I always want to focus on is going to be the relative weakness names in the space. Because if I'm going to go short, it has to be something that was already weak. I don't want to come in and, try to short some of the strongest names in the space. So that's why I wanted to look at Tesla and show you the way that the stock has been in a downtrend all year. We're also coming up on earnings next week, and you'll notice that this one has a daily squeeze as well. So, for this one, there were a couple different bounce points where it bounced up into the moving averages. Those are spots that traders can look at and try to get short when you have the cues trading to the downside, you have a relative weakness name, and then you can identify a squeeze and you can say, hey, you know what? This chart is consolidating. It has energy. It's ready to break out. It's most likely going to break out in the direction of the trend. At this point, Tesla's made a new low, so I wouldn't necessarily get into a short position right here. But we do have earnings next week, and that may be another catalyst and another reason to target some even lower levels, especially if we do end up getting a short-term bounce with that high put call ratio in the next couple days.
Tesla strikes me as one of those charts, Danielle, that's sort of guilty until proven innocent, right? I mean, it just continued to go down and down. What would you need to see on a chart like this to sort of flip the table and say, all right, now that's starting to be a constructive chart? Is it getting back above some of those moving averages? Is it an improvement in other indicators? Like what would be the thing you'd be looking for some positive sentiment on a chart like that?
Yeah, so I would need to see a shift in price up above the moving averages,
Yeah.
definitely up above the 50 at least. And I would need to see it up above those previous areas of resistance. So, a combination of that 50 simple and that resistance zone. So up above at least 180, but you can also look a little bit higher and you see that $200 key psychological value. Granted, if you traded it from 155 to 200, that would be a great trade, right? But on a long-term basis, it would still be in a bit of a downtrend because you have all that resistance there. So definitely above 180 and preferably up above 200 before I could say, okay, the trend is really shifting on this one.
It feels like a lot to prove there. Speaking of charts with a lot to prove, I guess Apple in that same bucket of weaker growth names, is it a similar idea here with Apple?
Yes. And so talking about both Tesla and Apple, one of the reasons why they haven't been doing well is because they've gapped down several quarters in a row post earnings. And now, we're right up against earnings again. And so if you look at Apple and you can see that, last quarter it gapped down and it's traded lower the majority of the quarter, and we're sitting on the lows of the year going into earnings. That just means that investors are not looking forward to this earnings report. Now, could they surprise? Yes, they can always surprise, but the trend and the overall chart patterns is telling us that this is a relative weakness name. And if this one falls off of that ledge, it can fall pretty far because that's really the last area of price support that we see. You have to go back quite a bit to identify some even lower support. So I am currently short Apple. I'm looking for a break of 168. I would like to target about 160 on this. We'll end up seeing, if that low breaks. But as of right now, it is weak. It's continued to be weak. And that last rally that it got failed really quickly.
That's a great chart. And on your chart, you have the, I think what we call the last close line. So you can see how it lines up with some of those previous closes. It feels like Tesla broke down. Apple may be, near doing that. We'll see what happens with earnings with both of those names. Now, semiconductors, obviously one of those bellwether groups that have done remarkably well, but also starting to show some signs of weakness. What's your take on semiconductors? You're obviously a big weight in the Qs as well.
So everybody wants to know what to do about the semiconductors, and people are asking me, how can I short this? Where can I short this? And I will tell you, it's really not my trading style to come in and short, the strongest sector of the year. So it's not really something that I'll do, but I will tell you that we're teetering on a support zone right here. And this one also has a daily squeeze. So again, you've got that consolidation that's going to break out one direction or the other. Right now, it's not looking that good. I wanted to see it up above 215. Today, it did break that level, but it's still holding the 210, 212 price point. I'll have to say that, below 210, especially now that it's breaking down below the 50 simple, that may be the spot where this thing fires short. And, as sad as that would make me, if it does fire short, it's going to drag the NASDAQ down. And well, if you want to short it, you're probably looking at about $200 a share, but only if that support breaks.
It's interesting. A lot of these charts, I feel, particularly some of the leading growth names, previous leadership, that is really kind of testing those support levels. I'm curious for something like semiconductors. We have Taiwan Semiconductor reporting earnings tomorrow. How do you think about earnings on some of the big components versus an ETF? Does it factor into your thinking? Are you sort of relating the two of those? Or do you think of the ETF just on its own as a purely technical play? How do you relate those two?
Oh, definitely. So earnings is a very critical part of my analysis, and I am going to be watching Taiwan Semi tomorrow like a hawk. I do like the chart. I think that it's been setting up really well. It's gapped up a couple quarters in a row post earnings. So I still think there's a chance that Taiwan Semi reports, the market reacts well, and SMH can hold. But, it's going to be heavily dependent on that report. And so if Taiwan Semi can't come through, then yes, that could absolutely have bad news and send SMH breaking through that support zone. And, the bad part about that is it causes people to sell, because a lot of people have made a lot of money in the semiconductors this year. And so if it starts breaking, you start getting this panic selling, and it can fall rather quickly, even though it's a strong space in the market. But, for me, my preferred situation would be we get a good report from Netflix, Taiwan Semi with that high put call ratio. Maybe Friday comes through, and then we start seeing short sellers cover. And I would personally prefer to be on the buy side. So, I'm looking for the opportunity to buy the dip in SMH if the market reacts well to those earnings reports tomorrow.
We were looking at Taiwan Semiconductor a moment ago. It's sort of testing that 50-day moving average. Netflix in a very similar situation. Is Netflix a name that you still like at this point, or is it showing too much weakness in your opinion?
So I think the Netflix is holding up really well. If you look at the overall chart, it's holding up. It's even up above the 21 EMA today. So I think relatively compared to a lot of these others, there is bullish anticipation. I think that has a lot to do with the fact that it has gapped up 2 quarters in a row. So, Netflix struggled a lot with the writer's strike, but that's now, largely behind us. Yes, a lot of shows were still very behind. But that was one of the main reasons why Netflix had such a rough time last year, and it ended up recovering really well. So I'm still positive on Netflix, but I will tell you that the earnings reports with this company are not consistent at all. They are not linear. The EPS numbers, if you go back the last 8 quarters and see, they don't have consistent growth. They also don't necessarily have consistent beats, and they don't have consistent reactions either. Sometimes you'll see Netflix actually miss their EPS estimates and the stock rallies. Sometimes you'll see them beat EPS estimates and the stock falls 6%. So the market is very jittery about Netflix. And that's why I try to separate the two and say, hey, I like Netflix. It's a solid company. I think they're going to do well. They have great bullish trajectory. But the problem is that the reaction can be a little bit all over the board. And so that's why it's most important to trade the actual reaction after the fact.
It's interesting with Netflix, you highlighted how it's been beating earnings in, last couple quarters, but you're right, with the streaming platforms, subscriber numbers have seemed to be way more important in a lot of ways. We only have about 30 seconds left, Danielle, but I'd love to go back to your chart of the QQQ. I think a lot of investors, a lot of traders are struggling to differentiate between a very buyable pullback that feels like a normal drawdown in a bullish year versus the beginning of a real disaster scenario. When you're looking at a chart of the QQQ, what helps you determine which of those scenarios actually plays out?
So I like to use Fibonacci analysis and I use symmetry. And so what I do is I go back and I look at the pullbacks that are similar to what we're seeing right now, and I measure those. So if you go back to about August, and you can even just, eyeball it on the chart. If you go back to August and you see these few downswings that we had, yep, that one right there, that one right there, and that one right there. If you take those swings and you project it from the most recent high that we've had and project it down into what is the low right now, you'll see that those swings are very similar. And
Pretty close, yeah.
Yeah. And so what that tells you is, yes, this is a little bit of a deeper pullback, but it's not abnormal for this ticker. So it's not anything that I'm going to say, oh my gosh, the sky's on fire. But if it did break through those symmetrical measurements and projections from those last 3 deeper pullbacks, that's where I would say, okay, this is getting pretty serious.
Yeah, markets often rhyme with some of those previous pullbacks. I appreciate that so much. Danielle, this is awesome. Really a pleasure to chat with you as always. Next time, let's do it in the studio. But for now, we're super thankful to talk to you today. So hang in there. Good luck through earnings season. We'll talk to you again soon.
Thanks for having me.
That's Danielle Shay. Danielle's the VP of Options at Simpler Trading, now here based in the Seattle area. That question at the end I thought was really, really insightful. All of her comments I thought were really thought-provoking, but at the end, really thinking about how you differentiate between a pullback and something more significant. Look at market history, right? Charts provide a fantastic history lesson to help you see what's happened before. So let's see how this current move relates to previous pullbacks. What might tell you it's something more significant? I think that was great comments and great thoughts by Danielle Shay of Simpler Trading. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here we have the S&P 500. We talked about some of the short-term vulnerabilities. I think Danielle Shay's comments about some of the leading growth names in some of those charts and what to look for, I think, was spot on. I'm concerned with the S&P closing below 50/50 today, that unlocks the door to potential lower lows and a potential deeper drawdown. So where do we go from here? I think you have a number of things you can bring to bear. Danielle mentioned Fibonacci retracements. I wholeheartedly agree. I'm running some what I call a Fibonacci framework on the S&P 500. That's where you look at a lot of different time frames and look at different Fibonacci levels, look for confluence when different levels agree. If you take the October low from last year, you take the recent high in late March, and you look 38.2% of the way down, that gives you a downside target of 48.15 and change. If you look to the left with this purple horizontal line, you see that lines up really well with the previous all-time high from the end of 2021 to beginning of 2022. So there's some symmetry to that 4,800, 48.15 level. That might be, I think that is my downside, initial downside target for the S&P, assuming 50/50 continues to hold, or another way to put that is assuming we get follow through below that 50-50 breakdown that we saw today. Now would be a time, if you don't have a good exit strategy in mind, thinking about different drawdowns and what they might look like. Now might be a really good time to do that. Chart number 2, we highlighted a number of charts today that are testing moving average support. And I would tell you, this is important for a couple of reasons. Number one, it's good to see whether a stock like Amazon will hold its 50-day moving average just from a trading perspective, right? Because if a chart overall is constructive, it should find support at a 50-day moving average like Amazon did back here in January of this year. But I think also there's a macro implication. If leading names like Amazon, which are, have great cash positions, which mean they should be relatively immune to higher interest rates because they don't have a lot of borrowing costs, they've been one of the best performers. The relative strength has been absolutely stunning for the last 15 months. So if an Amazon starts to break down, what does that tell you about the overall risk appetite for investors? It's not good. So I think Amazon's an important chart to watch, and certainly as long as it remains in that constructive pattern. Chart number 3, Home Depot. We talked about that concept of polarity. We talked about symmetry. We talked about pivot points where levels have meaning. I would say with Home Depot, we're approaching one of those levels. This is one of the biggest weights in the XLY after Amazon and Tesla. Home Depot is one of the top 3. And you can see that it's pulled back quite a bit from almost $400 a share to now down to almost $330 in about a month's time. 330 is pretty key because it's the 200-day moving average. It's also the previous resistance. So end of 22, beginning of 23, in July and August of last year, we all found resistance around 330, which is why that breakout above that level in December of last year was so meaningful. Now we've traded right back to that point, and I would say 330 is key. If Home Depot can hold 330, that's a pretty constructive chart. If not, I'd be concerned. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for our show. Special thanks to Danielle, Shay of Simpler Trading. Thanks for hanging with me as I get through the cold my family is passing around. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night. Hey. Yeah, Jeff, how you doing? No, Amazon looks great. The chart still looks good. I think you're doing great. No, I think you're going to be fine. Just keep at it. Good luck with earnings. Yeah, take care. All right, bye-bye.